All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
Hi, I'd like to welcome everybody back to our Fast Fives. My name's Greg Thompson, Senior Wealth Advisor with RBC Dominion Securities. And with me today is Rob Smith, my associate, and Ryan Harder, Vice President, Fixed Income Solutions with our Portfolio Advisory Group. Now, summer's been great, but the topic on everybody's mind these days is what is going on with interest rates, and have they risen as much as they're going to rise? Can we see further increases? When will they start to recede? These are all questions that have so many implications across the investment strata, and we want our clients to know what we think and what our people in Toronto think. So we've got Ryan Harder, who is an expert in fixed income, with us today. How was your summer, Ryan?
It was great. It was a little too short, but nice and mild and very relaxing.
Yes. And your Toronto Maple Leafs made very few moves, so hopefully they end the same way next year as they did this year.
Yeah, please don't advertise that too much. My roots are out west, and my family would not be happy to see any sort of association with the Maple Leafs. So I'm going to categorically deny any sort of rooting for the Leafs here. Okay.
Well, people are asking lots of questions about fixed income, and you're great to have with us and spend some time with us. So, Rob, what's on your mind?
Yeah, well, I am a Leafs fan, actually. So, I think it's been a good summer, Ryan, and I think we'll have a good year going forward. But with fixed income here, what is your current view, and where do you think interest rates are going at this time? What is the market priced in looking ahead at the next, 6 months or so?
Yeah, and there's a few ways to sort of look at this question. And Greg, you're right. This has been top of mind, not just now, but really for the past year and a half. But there's a few ways we can look at this. One, we can look at, what is the Bank of Canada saying when it comes to interest rates? We can look at what bond markets have priced in. And then, of course, there's just, what's there in the media and how do things feel. Certainly things feel like we're at peak rates, in other words, no more rate hikes, gradually falling yields. The Bank of Canada is saying they think it's possible that they're done, but they'll do more if needed. Bank of Canada Governor Tiff Macklem said last week that target inflation is in sight. That may not seem like all that much new information, given what inflation has done here recently, but for a central banker, that's a pretty meaningful thing to say. Then there's the bond market, which is also more or less pricing in. We're done with rate hikes. There's about a 50% chance of another rate hike before the end of the year, but that's all that's priced in. It's not uncommon for the bond market to have a fairly significantly different opinion than the Fed or the Bank of Canada, but currently I'd say, they're quite close to what the Bank of Canada is saying, at least in terms of the next 3 to 6 months. So it feels like peak rates. BOC is saying, we think we may be done here, and the bond market is saying, yes, we think they're probably done, and we'll start cutting rates in the second half of next year. The thing is, all of those that's how we felt earlier this year, too. The Bank of Canada was on a pause earlier this year. They chose not to raise rates in March. General sentiment was, okay, we're at peak rates. Bond markets are pricing in no further hikes, and they had cuts starting around the end of this year. Then inflation employment data stayed stronger than expected. Bank of Canada started the hiking again. Rate cuts pushed back by 2 or 3 quarters. So even if there's a general consensus out there, it doesn't mean that's what's going to happen. Rates are notoriously difficult to predict. That's true even for the Fed and the Bank of Canada, and they control things. Generally, my advice is to look at what the bond market is pricing in. That tends to be the least bad predictor of where rates are going. Personally, I still think the odds of rates staying higher throughout next year are underappreciated by the market. My view is there are structural components to inflation. We're going to need to see rates high to keep that under control. The good news is, because yields have risen so much already, there's a much greater cushion in place for investors. So The journey from 1 to 2% yields, it's a lot more painful than 2 to 3 and so on. For government bonds, we're in that 4 to 5% space. Could it go to 5 to 6? Certainly, I would be closer to that camp. But most short and intermediate term bonds are not actually going to realize a loss in that scenario. So I do think yields are going to stay higher, move a bit higher in the next year. But I think those big bond losses of 2022, I think they're behind us.
Well, that is good to know. Anything else on your mind, Rob?
Yeah, so it sounds like a lot of our analysts are, kind of calling for some form of a mild recession, coming here. And I just wanted to get your sense of what fixed income in general would look like, if it was a little bit less mild or if there was close to, if not any recession at all going forward. What would those two scenarios look like?
Yeah, I mean, it's worth noting, it's possible that the recession is here, that it's in the room right now. We had a negative Q2 GDP print unexpectedly. If we get another one of those in Q3, which it's a very real possibility, then technically we're in a recession, right? Not all recessions are made equal. And so I think that's a big component of this is what kind of recession are we talking about? Are we talking about mildly negative growth? In that case, I don't think the Bank of Canada comes in strong. If we're talking, something more like 2020 or 2008, those are both unique cases. That's a scenario where I think we see the traditional sort of response from fixed income, where yields are plummeting, rate cuts rapidly. I don't think that's going to happen. I think that what's more likely is that we get, this is essentially an engineered recession. It's kind of the point to slow down growth. It's not the point to cause hardship, but you can't get rid of inflation by just printing money forever, right? So the slowdown in growth is intended. I think what they want is to get as close to a recession as possible without actually going into it technically, bring inflation under control, and then we're feeling better. It's very difficult to have that type of precision with monetary policy, which is a pretty blunt instrument. So I think, if we have a mild recession, I don't think that there's a big disruption in fixed income markets. A severe recession, sure, and I think that's where your long duration government bonds are going to do well. But for the most part, rate cuts, I do not think are going to be rapidly forthcoming unless there's some much larger issue with the economy, which is not something that I see happening.
And last one for me here, it'll kind of lead us into Greg's questions too, but where do you see the best value today in the fixed income markets?
I think there's a lot of places where there's good value in fixed income. Fixed income broadly, to me, is quite attractive if you look at it relative to equity valuations. We're at multi-decade type of levels in terms of attractiveness. But really, the part of fixed income that I think is the most attractive is the lowest risk part of fixed income. So, for years, we really had to get used to no yields from government bonds. If we wanted anything meaningful, we had to pile on the credit risk. But the vast majority of the increase in bond yields has come from base rates, not from the spread on the credit risk component on top of that. So think about a corporate bond in 2021. Maybe a quarter of the yield, which was very low at that time, maybe about a quarter was coming from base rates. That's the rate hikes component, right? The rest is coming from the credit risk, the credit spread inherent in that bond. Today it's flipped. So about 3/4 of the yield in a corporate bond, the average Canadian corporate bond, is coming from base rates. The rest is coming from the credit spread. So you can get the majority of the yield available today while staying low risk, whether that's credit risk by staying with high quality companies or governments, or interest rate risk, which means staying relatively short. It's an inverted yield curve, which actually means you get less yield by going out with long-term bonds. So it's a good time to be kind of turtling up. I don't want to say scared, but if you're worried about what's going on in the market, fixed income is a great place to be right now because you can get a very reasonable yield. And then on top of that, many high credit quality or even government bonds, they're trading at very steep discounts. And as long as it was not issued at a discount, so it has a coupon but happens to be trading at a discount, that pull up towards par, it's going to mature at $100 as long as it doesn't default, which for high quality bonds is extremely unlikely, and for governments essentially impossible. It's going to get up to $100 as long as it doesn't default. you're getting to that point, and that pull to par, which is a big component of the yield, that's taxed as a capital gain. So for taxable Canadian investors, you can get the majority of your yield from capital gain, which is a very powerful driver for after-tax yields. So I think, low risk is a place where there's a good opportunity for the most part. And particularly for Canadian taxable investors, this does not apply to Americans. You can benefit from those discount bonds where most of the yield is actually coming from a capital gain and much more tax efficient.
All right, so again, bonds have sold off, rates have gone higher. And the one thing that has surprised me, and it seemed to start about a year ago, when the Canadian banks stopped calling back their preferred shares, we've seen the rate reset preferreds sell off. And to me, that doesn't make a lot of sense, because these rate resets are going to be coming up for renewal. And when they reset their rate, the rates are jumping from cash yields of anywhere from 6, 7, 8% in dividend income. Why have we not seen the rate resets rally with the higher interest rates on government bonds?
Yeah, so it's a good question. I think there's a few components here. And the conventional wisdom was higher rates, it's good for rate reset prefs. Yet last year we saw them really declining step for step with fixed perpetuals versus fixed for life. For those, it makes a lot of sense. If yields are going up and you're getting a 4.5% dividend for life, and interest rates go up 1%, that 4.5% rate is not so attractive. The price needs to fall to get that yield up. But rate resets are going to move higher with rates, so they should do at least better, right? The reality is, it's pretty complicated when it comes to which issues are going to do well with rising rates and which won't. But some of them can be kind of neutral. Some of them can be mildly negative. The vast majority of the market now should be positive because they're all trading at discounts. And at the very least, they should have done considerably better than fixed perpetuals, and they haven't. So I think rate resets are starting to look very cheap. I'd rather be buying than selling, and that's particularly true for the stuff trading under $20. If saying high rates is good for rate resets, it is a bit of an oversimplification, but it's not untrue either, broadly speaking. And I think they've been treated unfairly, and particularly, this extended decline this year. Many issues, as you mentioned, Greg, are resetting substantially higher, and you can get high single-digit cash yields on reset from some really high-quality names, and that series of dividend raises, that's going to continue as long as the 5-year stays up. That's going to continue, and there's some really attractive yields. So it's unfortunate that the pref market seems to undergo this gyration every 2 or 3 years where they just sell off seemingly without reason. I'd love to come here and give you a good reason, other than the fact that it's a relatively small market and is retail dominated, which means it tends to have more following in and falling down and falling up, right? There's more piling on, and that's unfortunate from a volatility perspective. But the good thing is, if you can keep your head in those periods, they offer a really good opportunity every 2 or 3 years to pick these up on the cheap, and that's where I think we are right now.
Yeah, no, I think it's incredibly cheap again, and you're going to get well paid to wait for that catalyst. And I'm not sure what that catalyst would be. Would it be the banks deciding to begin to call them away again, which they could once they get their capital ratio cushions back under control?
Yeah, that's possible. The issue is that for banks to start calling those issues again and refinancing, they'd have to refinance them at substantially higher spreads. So they're not going to do that for a while. Things have to improve in the pref market, and I think that they will. And honestly, I think what the true catalyst is, which is not a catalyst at all, is just time. I can tell you anecdotally, virtually all of the sentiment that I'm getting is they're saying, Ryan, can you look at these prefs? Nobody's asking me what to buy. They're asking me, what should I sell and what should I hold? it's taking everything to just hold the line on this, and I totally understand that. But that's how things felt in 2020. That was the exact same scenario in 2020. Nobody wanted to buy these things, and they were a great opportunity. That's the opposite of how it felt in 2021, when late 2021, everybody wanted to buy these things, right? So, and that was the time that in retrospect, that they were more expensive than in the recent past. So, buying right at the low, it's always going to feel a bit scary. If it didn't feel scary, then everybody would be doing it, right? Like they were in 2021. But every month that passes, more and more rate resets are getting those big raises. Now, one other thing which isn't going to inspire a lot of confidence, but I think it's worth mentioning, and I think it's playing into the weakness that we've seen this year, is a proposed dividend tax change from the federal government. This will not affect, any of your listeners will not be affected unless they're a bank or an insurance company. But it's not going to affect the dividend tax credit at all. But banks and insurance companies who own prefs, and they own a decent chunk of the market, we don't know exactly how much, but our estimate is at least 12% and probably around 20%. The proposed tax change is those were tax-free for Canadian dividends for financial institutions. That's no longer going to be the case if this gets passed, which it still hasn't. It was proposed in the spring budget, and it's expected to come into force next year, but still not a certain thing. That means that those banks and lifecos and P&C insurers are more likely to reduce their exposure to prefs. If they're doing that, that's just a net selling. And I think that's part of what we're seeing this year, where they're adding to that selling pressure. They're saying, these went from tax-free to us to we're going to be taxed on those dividends. Let's reduce our exposure. We're not going to do it all at once and kill the market. But I think that's part of what is keeping things so cheap. So that's not good news on the face of it. But I do think it's going to extend this buying period longer than we usually have. We usually don't have, kind of a year plus to get in at the really good prices. I think it's one of those technical headwinds that it's not a fundamental reason not to own prefs. I don't think there are good fundamental reasons that you should be that the yield should be as high as they are, because the risk is not greater than it was previously. The chance of suspended dividends, other than one specific name, are very, very low. Still very high credit quality. There's sentiment is poor, and there is this change, and I think that's why things are so cheap. And maybe we haven't hit bottom yet. I do expect that things will be more volatile. But even if you told me we haven't hit bottom, I'd still rather be buying here than selling, because you're getting paid so much to wait.
Well, and it's tax beneficial income when held outside of a registered account. So yeah. You're right. It is incredible. It is incredible. Okay. Well, I always like to think of one thing that we haven't talked about prior to this. And so, in your mind, higher for longer expectation?
Yeah. And the reason I think that is, I think that we are past, I think what seemed like they were indefinitely structural parts of disinflation, in retrospect, are looking like they were more temporary. And mostly, I mean, China becoming the world's factory. And most of that heavy lifting has been done. Mostly, we can't globalize indefinitely forever, right? And there's a lot of things sort of moving in the opposite direction. So the goods component because if you look at goods inflation and services inflation, it's not like they've both been low from post-2000, right? It's just goods. It's goods coming down and services going up. Anybody who's getting haircuts or going to university knows this, right? So that component is strong and has always been strong. And so can we rely on goods getting cheaper to offset that inflation? I don't think we can to the same degree that we could over the last 20 years. And the other component of this is fiscal deficits are much larger on a going forward basis, even aside from the COVID stuff. There were election periods in Canada where part of the debate was whether or not a $10 billion deficit was sustainable federally. Then we saw $350 billion in 1 year. And so that's 35 years of deficits in a single year. And obviously that was COVID, and that was unusual, and we haven't continued that pace, but we have not got anywhere down to where we were previously. And it's the same in the US. And now that interest rates are going up, there's a structural component to that deficit, which is the interest expense, which just keeps going up and up, right? As they refinance, just like the rest of us. If we're refinancing our mortgages, they're refinancing at a higher rate. The government is doing the same thing. So not only is the debt pile growing fairly substantially, but the interest expense on top of that as a percentage is also increasing and will continue to do so for years. And so that's a structural component of the deficit that I think is also going to play a part in higher inflation going forward. And you know, it kind of gets at this mix of, there are parts of higher rates that are actually pro-inflationary and make things more expensive. The idea is, on the whole, they make inflation less likely, but there are certain components, and the fiscal deficit is one of those. So I think they're going to, I'm not, calling for like 7 or 8% interest rates. I just don't think that we're going to get rate cuts by the second half of next year, which is what the market is pricing in.
Yeah, no, I'm with you. I think they're going to be higher for longer. And, we haven't tried to get too fancy with our fixed income. We have a ladder of bonds. We think that ladder protects us. If rates rise, we have money coming due to reinvest at the higher rates. If rates fall, we have money longer out to that are locked in at the higher rates for a longer period of time. So like rungs in a ladder, we have our maturities spread out over a 10-year period, and we're pretty comfortable with that. And, high quality investment grade debt. So again, fixed income was awakening last year. People realize that actually at times it does go down. But as I've said to so many people, that the last 15 months where, rise in interest rates have been, hard on the accounting statements, will pay off for you longer term because you're actually getting income from fixed income. 2 years ago, the acronym was TINA. There is no alternative. Nowadays, there's alternatives. And with our clients, we're revisiting our asset allocations to make sure that they make sense in light of the changes. But
yeah.
Ryan, thank you so much. That's a lot to take in for ourselves and our clients. And anybody else who's watching, so we don't want to crowd it with too much more. We really appreciate your time. We really appreciate all this stuff. And it's great to have a resource like you down in Toronto to get the lay of the land. So thank you again.
Yeah, thanks for having me. Always a pleasure.
Okay, take care.
Thanks.